Welcome to a deep dive into U.S. finance. We're going to be cracking open Investing in U.S. Financial History by Mark J. Higgins. And we're going to go all the way from the Founding Fathers to the dot-com bubble and beyond.
I think one of the most interesting things is how you see the same patterns throughout history. It's not a matter of history repeating, but it's the same forces at work.
Absolutely.
Yeah.
So let's rewind to the very beginning. Powdered wigs, quill pens. Alexander Hamilton, America's first Secretary of the Treasury, our original finance influencer.
Yeah, so after the revolution, the U.S. was in serious debt. What Hamilton realized is that, financial stability wasn't just about balancing the books, it was about building trust, both at home and abroad.
Okay, so what did he actually do? What were some of the strategies that he implemented? Higgins calls them innovative.
Well, he convinced Congress to assume all the states' debts. So bring it all under the federal government, which instantly boosted the creditworthiness of this brand new nation.
Pretty clever. But consolidating debt doesn't make it magically disappear.
Right, and so that's when he created the Bank of the United States. Now, this was definitely controversial, but it provided a central place to manage government funds to regulate currency and ultimately promote economic growth. The whole idea was to establish trust, foster stability, and really get those financial wheels turning.
And you know what, it worked?
He really does sound like a superhero of finance. But even superheroes can't prevent everything. Higgins also mentions the Panic of 1792. Was that a sign that maybe things weren't as foolproof as they seemed?
Yeah, the Panic of 1792 was America's first major financial crisis. And the interesting thing is that Hamilton, having studied, previous crises, he realized that there were times when the government needed to step in to prevent a complete meltdown.
So he bailed everyone out. That sounds awfully familiar.
It's very similar, yeah. He orchestrated a bunch of government bond purchases, injecting liquidity into the market and stabilizing the system. It's amazing the parallels between his actions then and, say, the 2008 crisis centuries later. This whole idea of balancing risk and reward, speculation and stability, it's a constant theme. So as Hamilton's laying this foundation, we've got the U.S. trying to establish itself, what's happening on the ground. Isn't this about the time that Wall Street starts to emerge?
Yeah, and this is where things start to get interesting. So while Hamilton's focused on the national level, you have this different energy brewing in New York. A group of merchants, they meet under a buttonwood tree, and they sign this thing called the Buttonwood Agreement. This is 1792, and that actually laid the groundwork for what would become the New York Stock Exchange. It was the beginning of Wall Street, as we know it, a place where fortunes could be made and lost just as quickly.
The Buttonwood Agreement.
Yeah.
Got it. So we've got Hamilton trying to stabilize the nation. The New York Stock Exchange starting to take shape. What else defined this very early era of U.S. finance?
Well, don't forget about the goldsmiths. Now, they weren't just making jewelry, they actually pioneered something that we now know as fractional reserve banking.
Wait, isn't that the same system that we use today? Where banks are lending out way more money than they have on hand.
That's exactly right. The goldsmiths figured out that they could lend out a portion of the gold that people deposited with them, basically creating new money. It was a revolutionary system, but like anything else, it had risks.
And that risk, I'm guessing, reared its head in 1819, the Panic of 1819. And another financial crisis. Are we seeing a pattern here?
You got it. The Panic of 1819 was a harsh reminder of what happens when you have excessive lending and speculation. Land prices crashed, banks failed, and this very young nation experienced its first major economic downturn. It reminds us that even back then, over-leveraging and speculative bubbles could have really devastating consequences.
It's like plus ça change, plus c'est la même chose. So we've got this foundation that's been laid, but there are definitely some cracks starting to show. Where do we go from here?
Well, from here we move into the Gilded Age, a period of immense growth, but also a time when those cracks start to widen and things get a lot more interesting. The Gilded Age rate growth, but also a lot of corruption. This is where Higgins' book really gets going.
Yeah, it seems like those two things often go hand in hand, progress and its shadow. So what's at the heart of U.S. finance during this period?
Railroads. They were transformative, connected the entire country, fueled an industrial boom, the likes of which the world had never seen. But that kind of rapid expansion, it always comes at a cost.
Okay, so let's talk about that. What were the downsides to this railroad revolution?
Well, for one thing, it was a breeding ground for corruption. Bribery, insider trading, shady land deals. Higgins talks about how these railroad tycoons, they became the original robber barons, making fortunes while exploiting workers and grabbing land, often with total disregard for the rights of Native Americans.
Yeah, it's a tale as old as time. The allure of wealth, what people will do to get it. But were these guys just greedy, or were they also brilliant?
Oh, they were cunning. There's no doubt about that. You look at a guy like J. Gould Higgins, calls him the Mephistopheles of Wall Street. He was notorious for manipulating stock prices, often ruining his rivals. And then there's Daniel Drew. He used a tactic called watering the stock, basically artificially inflating the value of his railroad companies.
Watering the stock? What does that even mean?
Imagine you buy a glass of milk, right? But instead of getting pure milk, it's been diluted with water. That's essentially what Drew was doing. He would inflate the number of shares in his companies, making them seem more valuable than they actually were. So unsuspecting investors would buy in, and then when the truth came out, their investments would vanish.
Wow. Talk about unethical business practices. It sounds like the Wild West of finance.
It practically was. And just like the Wild West, it was a time of booms and busts. Remember the Panic of 1873?
Vaguely. Remind me what happened.
It all started with the collapse of J. Cook & Co. They were a financial institution that had invested heavily in, you guessed it, railroads. And when those investments went sour, it triggered a chain reaction. Bank runs a stock market crash, the whole 9 yards.
So even these titans of industry weren't immune to the dangers of speculation and risk. Makes you wonder if someone like Jay Cook could fail. Is anyone truly safe?
That's the nature of financial systems. They're built on trust. And when that trust erodes, even the most seemingly unshakable institutions can crumble. The Panic of 1873 is a perfect example of that. No matter how much the financial landscape changes those fundamental elements of risk and confidence, they always remain.
So we've got corruption, manipulation, and panics. What else was going on during this era? Didn't the U.S. also undergo a massive economic transformation around this time?
You're right, the U.S. was rapidly becoming a global industrial power. This era saw all sorts of innovations in manufacturing, a relentless focus on efficiency and standardization. Higgins specifically talks about the American system of manufacturers, which emphasized interchangeable parts and mass production. The goal wasn't just to make things faster, it was to make them better and cheaper, which ultimately propelled the U.S. to the forefront of the world's stage.
So while Wall Street was having its ups and downs, the real engine of growth was happening on factory floors across the country.
Precisely. But even with this newfound economic might, the U.S. was still grappling with financial instability. Remember, there was no Federal Reserve yet to act as a safety net. And that brings us to the Panic of 1907.
Okay, set the scene for me. What led to this particular crisis, and why was it so significant?
Picture this, a group of speculators led by this larger-than-life figure, Augustus Heinze. They try to corner the market in United Copper. Their plan blows up in their faces, triggering a wave of bank failures and a stock market plunge. It was complete chaos.
Well, that's familiar. Hubris speculation, a healthy dose of panic. How did they finally get things under control?
This is where J.P. Morgan steps in. Now, Morgan wasn't just a financier. He was practically a one-man central bank during this crisis. He rallied the other bankers, pooled their resources, and essentially bailed out the entire financial system.
Wait, so a single individual held that much power? That's both impressive and a little terrifying.
It really shows you how much influence Morgan had. But it also exposed a major flaw in the American financial system, the lack of a central authority to manage these kinds of crises. The Panic of 1907 became a turning point. It fueled calls for banking reform and ultimately paved the way for the creation of the Federal Reserve. You know, it's funny how these things work. One minute you have this massive crisis, and the next minute you have a whole new financial system.
Right, like JP Morgan swoops in, saves the day, and everyone's like, yeah, central bank, maybe that's not such a bad idea after all.
Exactly. The Panic of 1907, it really forced people to think differently about how to create a more stable financial system. And so in 1913, the Federal Reserve Act was passed, and that established the central banking system that we still have today.
Which brings us to the Roaring Twenties, flapper dresses, jazz music. It seemed like the party would never end, but Higgins points out that underneath all that glitz and glamour, some serious economic trouble was brewing.
It's true. There was incredible technological progress, economic growth, but it was also a time of rampant speculation. Lax regulations, people were buying stocks on margin, taking on these huge debts. Banks were making risky loans. Does any of this sound familiar?
It's like we're looking at a distorted reflection of our own history, right? All of the excess, the belief that this time it's different, and then, of course, the crash of 1929. What happened?
The bubble burst, stock prices plummeted, fortunes were wiped out overnight. It led to panic, bank runs, people desperately trying to withdraw their savings. It was irrational exuberance followed by a complete and utter loss of confidence.
And the fallout from all of that, the Great Depression.
Yeah.
Must have been a terrifying time.
It was a time of immense hardship, Unemployment skyrocketed, businesses failed. Breadlines stretched on for blocks. Higgins really drives home the devastating consequences of this financial collapse. It showed just how dangerous unchecked speculation and a lack of regulation could be, how it could impact the lives of everyday Americans.
So how did the U.S. government respond to something of this magnitude, the New Deal?
Exactly, Franklin Delano Roosevelt's New Deal. It was a series of reforms designed to pull the nation out of the Depression. But it wasn't just about providing relief, it was about completely changing the role of government in the economy and laying the foundation for a more stable financial system.
Give me some specifics. What were some of the key reforms that the New Deal brought to Wall Street?
One of the biggest was the Glass-Steagall Act of 1933. This act separated commercial banking from investment banking, essentially preventing banks from using depositors' money for these risky investments. It was a direct response to the kind of speculation that led to the crash.
So basically trying to put some guardrails back on the financial industry.
Exactly. And then you have the Securities Act of 1933 and the Securities Exchange Act of 1934. These acts were all about restoring investor confidence by forcing companies to be more transparent about their finances. And of course, creating the Securities and Exchange Commission, the SEC, to regulate the stock market and prevent fraud.
Transparency and oversight. Two things that were clearly missing in the years leading up to the Depression. So these reforms were a pretty big deal. What was their lasting impact?
They redefined the relationship between the government and Wall Street. The New Deal ushered in stricter regulations, increased oversight, a much greater emphasis on consumer protection. It wasn't perfect, but it was a step towards a more stable and equitable financial system.
So we've covered panics, crashes, reforms. What's next in this wild ride through U.S. financial history?
Well, after World War II, we see a new era emerge, the rise of institutional investing and a fundamental shift in how everyday Americans interacted with the stock market. And one of the key players in all of this, Merrill Lynch.
Okay, I'm listening. Tell me more about Merrill Lynch and how they changed the game.
Before Merrill Lynch, investing was really a game for the wealthy elite, but Charles Merrill, the founder of Merrill Lynch, he had a different vision. He wanted to make investing accessible to everyone.
That's a pretty radical idea for that time. How did he go about doing that?
He believed in education and transparency. Merrill Lynch focused on educating the public about investing, offering financial advice to everyday people, making it easier for them to buy and sell stocks. They were pioneers in bringing Wall Street to Main Street.
It's amazing how far we've come from those merchants trading under the buttonwood tree. So while all of this is happening, what's going on with institutional investors?
Well, that's another major shift that happened during this period. Pension funds, endowments, mutual funds, they all started amassing huge amounts of capital, and they became major players in the stock market. This influx of institutional money, it changed the entire dynamic of the market, creating both opportunities and new challenges.
So we've got everyday Americans investing institutional money pouring into the market. Sounds like a recipe for more booms and busts.
Sadly, yes. The latter half of the 20th century saw periods of incredible growth, fueled by technological innovation, but also by speculative bubbles like the dot-com bubble of the late 90s, and of course the housing bubble of the 2000s. And as we know, those booms were followed by some pretty painful busts.
It seems like no matter how much we learn, we still make the same mistakes. So here we are in the 21st century. Are we any closer to figuring out a truly stable and equitable financial system?
That is the million-dollar question, isn't it? If there's one thing we've learned from Higgins' exploration of U.S. financial history, it's that it's a story of innovation, risk, adaptation. There will always be new challenges, new bubbles to deflate, new lessons to be learned.
It's a story that's still being written. And on that note, dear listener, we'll leave you with this thought. What will your chapter in the ongoing saga of American finance look like?